Intraperiod Tax Allocation. Bright Company reports the following information for the year ended December 31st, 2019. Pre-tax income from continuing operations, with a little footnote that we'll read in a second. Pre-tax income from operations of a discontinued Division M. Pre-tax loss on disposal of Division M. Pre-tax correction of an error in understating depreciation in 2018. Retained earnings January 1st, 2019. Cash dividends during 2019. And income tax payable with this footnote. So the footnote that aligns to the pre-tax income from continuing operations says of this amount, revenues are $400, expenses are $240. And the footnote that aligns to the income tax payable says that of that amount, $6,750 relates to pre-tax income from the operations of discontinued Division M. Pre-tax loss on the disposal of Division M resulted in income tax savings of $11,250. And pre-tax correction of the depreciation error resulted in the income tax savings of $2,000. Prepare the year-end journal entry necessary to record the 2019 interperiod income tax allocation. So December 31st, we're going to have our income tax expense, and then we're also going to have these other things that are listed here. So that income from operations of discontinued Division M, our retained earnings, loss on disposal of Division M, and then we'll have our income taxes payable. And so we can start filling in some of this information. So the income from the operating of our discontinued Division M, we know that $6,750 relates to that pre-tax. So $6,750 will carry down. And then this retained earnings is here because of our depreciation error resulting in the income tax savings of $2,000. The loss was $11,250. And our income tax payable is given to us in Part B of $41,000. And so we can use that information to determine the income tax expense. So we'll add together our payables, or the income tax payable, the loss on the disposal, the retained earnings, which relates to that depreciation error, subtract out the income from the operations of that discontinued division, for income tax expense of $47,500. Part 2 says to prepare the income statement and the statement of retained earnings. So we have the Wright Company income statement for the year ended December 31st, 2019. We're going to have revenues and expenses to give us pre-tax income from continuing operations. Then we'll subtract out the income tax expense, which will give us income from continuing operations. Then below that, we'll display the results from discontinued operations. And so we'll have the income from operations of discontinued Division M and the loss on disposal of discontinued Division M. And then finally, we'll be able to display net income. So now we can start plugging in this information. Revenues, they told us, are $400, and expenses $240, to give us that pre-tax income of continued operations of $160. Our income tax expense is the $47,500. To give us income from continued operations of $112,000. Then our income from operations on the discontinued Division M is going to be up here to $27,000 minus the $6,750. Now we'll do the same thing, because remember that we're showing these net of the income tax. So the loss on disposal is, I'm going to put a negative sign here to convert this to a positive amount for income statement, 45,000, and then we have to subtract out the 11,250. And so then we have net income, sorry, did that backwards. So our loss minus this income, I accidentally added them together. And we'll subtract that out since it ends up being a loss, and we get net income of $99,000. And really we should put some lines in here to make this look better. The statement of retained earnings. So I'll copy this down. And we'll just change the title to Statement of Retained Earnings. We'll start with our retained earnings as of January 1, 2019. Then, because we have that prior period adjustment, we're going to subtract that out here to get our adjusted retained earnings. So we'll say less prior period adjustment, understatement of 2018 depreciation expense, and that'll give us our adjusted retained earnings as of January 1, 2019. Then, like normal, we add our net income, we'll do a subtotal there, we'll subtract out the cash dividends, and that'll give us retained earnings as of December 31st, 2019. And so we can grab this information from up above, I think. Oh yeah, retained earnings, January 1st, 2019, 410. Then we have our adjustment for the prior period under statement of depreciation expense. And so we have this 8,000, and then we already did the tax adjustment of 2,000. So we'll add those together, because this is negative 8,000 and this is a positive 2,000, which is why we're adding together, for negative 6,000, which gives us an adjusted retained earnings balance of 404,000. Then we have net income. Maybe, oh, went way too far. I was looking for it in the information, but we just did the income statement, so we prepared net income. And so that gives us 503, and then we have the cash dividends. We want that to be reported in the negative, so I'll put the negative sign there. For a retained earnings balance at the end of the year of 455,000. And again, we'll just add our lines in here so that we can more easily identify those subtotals. And there we have it.